Let's get into our stock of the day. It is Xero, the online accounting software company. It's posted revenue growth of 28% to about 1.4 billion Kiwi dollars. That's 1.3 billion locally. Xero posting earnings decrease of 26% to 158 million Kiwi, attributed to incurred non-cash impairments and associated costs and restructuring charges. The company reporting a net loss after tax of 113.5 million Kiwi dollars, compared with a 9.1 million loss in the same period last year. And taking a look today, the market likes what they're seeing at the moment. In fact, as you can see, it has crossed that $100 level, up more than 8% today. So, Michael, how are you looking at this result? And I guess more importantly, what you're seeing going forward for Xero?
Yeah, look, it's obviously better than expected. I mean, we did some research on it several weeks ago, and we thought, look, despite the run up in the share price, the valuation didn't look too demanding. There was scope for improvements in terms of cost cutting, and we know that the business can be quite resilient with their prices, and that seems to have come out in today's results. So, R&D spend was lower than expected. Cash flow seems to have, even exceeded expectations. And despite the shares having trended higher since November, so there was a nice sort of charting pattern there as well. It doesn't look like they've run up too hard into this result. So, it wasn't all priced into the shares leading into it. So, look, a nice pop up today. Look, I think there's a level here on the chart where we may see a bit of consolidation. The magic $100 mark might see some people taking profits off the table. But I think if this can, hold in here over the next few days or so, just under $100, and we don't see a wave of profit taking come in, then yeah, it might continue to head higher. Of course, we have the background where tech stocks in general have continued to appreciate. If we look at the NASDAQ, that looks like it can continue to head higher in an environment where interest rates are likely to have peaked or only have one more rate rise ahead of us. So, longer term, I think it can do well.
Am I taking that as a hold?
Yeah, it's a hold. Not necessarily a buy. As I said, I'd like to just see what it does in the next few days. But if I was holding it, I'd be happy to continue holding. All
right, good one. Luke, how do you look at it? And psychologically it does play a part, doesn't it, given it has crossed that $100 level?
Yeah, it does. It shouldn't, but it definitely does. Look, this is a good example of how the market's always forward-looking. This result is good, but it's also Xero management taking some medicine for some pretty poor capital allocation decisions over the last few years. Some big write-downs to some acquisitions they've made only a year or two ago, and sort of maybe putting an end to the idea of Xero as a platform and just refocusing back to their core accounting business and driving that in Australia and overseas. And so, the actual result today is okay, but it's the outlook that I think's excited the market, and the prospect of a further opening of the leverage within this business as management's called for revenue growth to continue, but for the operating expenses of the business to continue to trend down as a percentage of revenue, from sort of around 80% back to 75%. So I just, jumped on the calculator, run some rough numbers, trades on about 150 times operating earnings, extremely expensive on this result. But the reason why we like software businesses, the market likes software businesses, is the leverage they can get and the scalability they can get. And so, you run the rough numbers on where management expects to be, maybe assuming 15-20% operating revenue growth next year, and that operating line sort of doubles, and that multiple falls down to maybe 65-70 times operating income. So that's still very expensive. And so to come back to Michael's point, I agree with his outcome. It's a hold here. It's tough for me to say buy because it is still quite steep at a valuation, and you could see some profit taking around the $100 level. But I think this is a trend you'll see from a lot of businesses like Xero, where they've probably put too much fat around the business, around the cost base through that post-COVID 2021 period, but you can really shrink that down and you can see that earnings engine come through from that core business, which is fantastic. So I would struggle to tell anyone to sell, and I think the market's quite right to focus on management. Finally, maybe took a few missteps the last couple of years, but it looks like that focus is now intact, and the business is set to do quite well over the next few years.
Good one. That is Xero, hold from both.